Everyone, Michael here. So in this video, I'm going to walk you through the Roku company report. And this is part of my investing process where I first discover a company that I want to investigate. And basically I look through its company report on Simply Wall Street. And then I'll share with you what my next steps are as to, once I finish that, what further things I want to look into that help me decide whether or not I want to buy this stock or put it on my watch list or just forget about it altogether. So for starters, how did I get onto Roku? Like, how did I stumble across the stock? Well, just to give you some context, I was reading an article written by one of the analysts, Stephen, at Simply Wall Street, and it was basically talking about how there's a bit of a divide about Roku at the moment, because if you're familiar with the stock, you'll know that it's declined almost like 50% since its highs in July. And that's what this article talks about. And it says there's a few concerns, like it potentially has like a rich valuation. It's got like sort of flattening viewership numbers. And there's a disparity, or like a bit of a difference between what a whole bunch of analysts out there recommend or believe that the stock is worth in terms of like a price target. So some have it rated as a buy and some have it rated as a sell. And ultimately the company's performance has been really stellar over the past couple of years and the share price has followed suit. But it's pulled back considerably in the last 5 or so months. And so having known that and knowing the company vaguely, I wanted to have a look into it a bit further because basically it talked about like a rich valuation might be a bit of a problem. The stagnating sort of viewership could be an issue, and the fact that there's a few concerns about the overall market growth of what Roku operates in. So I wanted to have a look at the company report, and then once I had a look at that, I kind of want to delve into it a bit further and see what next I can learn about, like, for example, the market that it's in. So as I mentioned, the company report is one of the first things I look at when I'm investigating a stock, and I'll just walk you through the report and share with you what I'm seeing. So like the other videos I've done, the first thing I look at is the Snowflake over here. And just having a look at this, I can see that the company has really good future prospects, pretty good track record, exceptional balance sheet, like very strong financial health. Doesn't score well on the dividend, but I already know that it doesn't pay a dividend. And in terms of valuation, it could be good, could be considered good value in some metrics. So from that right there, the Snowflake summary pretty much is that it has like a flawless balance sheet and it's got high growth potential. So that's what I've been aware of already, and that's kind of like a very interesting quick takeaway, and it shows me like of all these 36 metrics that are checked here, that's what a good high level summary is. So good to know that's the score right now, and then I'll get more color on it as I go through the report. So the next thing I check out is the risks and rewards. And so the first thing here for the rewards is basically that according to Simply Wall Street's valuation model, it could be trading at a discount of about 27% below its estimate of fair value. So according to like a discounted cash flow model, this company might be trading at a discount depending due to the model that Simply Wall Street has run. So I'll get to that in just a second. The next reward here is that the earnings are forecast to grow at 33% per year for the next couple of years, and that's according to analyst estimates. So that's a pretty high growth rate, and that's pretty solid and helps back up why the company has such good future prospects. So that's promising to see. And the next reward was that it became profitable this year. So another bonus, the company has finally broken into the black. So good to see that it's actually able to generate some profits. And I'll get more color on that in the past performance and future sections as well. And the only risk that's labeled here is that shareholders have been diluted in the past year. So that's something I'll want to look into further down in the ownership section just to see how much shareholders have been diluted. And one thing to keep in mind is if you're an existing shareholder and a company has like a really generous equity compensation plan with all of its managers, or it chooses to keep issuing new shares and ends up diluting shareholders, that's really an issue for you as an existing shareholder because ultimately your slice of the pie becomes smaller. However, it's not as big of an issue if the company is growing its value incredibly quickly, right? So if your slice of the pie is decreasing, but the size of the overall pie is growing incredibly quickly, then it kind of counteracts itself and it's not that big of an issue. But if the company is not growing that quickly and your slice of the pie is reducing, then that could be an issue. So given this is like a high growth company, it's relatively common for it to have shareholder dilution issues. So I'll look into that and see if the rate of dilution is counteracted with like enough earnings growth and ultimately the company growing quickly. So I'll get to that in the ownership section. Now the next part I look at here is basically just the competitors to see who Roku is up against. And some of the competitors here are the likes of Disney, Dish Network, and these other stocks here who I'm not really too familiar with, to be honest. So they could be some interesting opportunities that I'm not aware of. But just having a look at the snowflakes, it seems like Roku seems to be the best in terms of financial health, so you can see that it passes like 6 out of 6, whereas none of these stocks do. Disney has okay future prospects, relative like not the best track record, and seems to be could be okay value. BCE, who I'm not familiar with, doesn't pay that much. Sorry, doesn't have the best track record either. Not too good financial health. Okay dividend, like not that best value, and doesn't have the best future prospects. Dish Network basically does okay in the health section, has a pretty good track record, not too good in the dividend, pretty good value or moderately good value, and doesn't have the best future prospects. And then OzTech, who I haven't heard of either, has incredible dividend, really good value, very solid financial health, really good past performance, but doesn't have the best future prospects. So this is interesting. I might have a look into this stock after I have finished looking at Roku. But yeah, this is just like showing me like a few competitors and how they basically stack up on the snowflakes as well. So that's interesting. Now the next part I look at is the price history and performance. And basically this section here is like, I don't use the share price as like an indication of whether I buy or sell, right? Like if the stock goes up heaps, I should buy, or if the stock crashes heaps, I should sell. I do not, and I recommend not using share price performance as like an indicator of whether you should buy or sell, because that tells you nothing about the underlying business, right? Like you need to look at the underlying business, and that is what you base your decisions off. So as an investor, you want to know what's happening in the business itself. And in this particular section here, what I do is I go through all these updates that have happened. I typically go over the last 3 years and basically look at like the strategy updates that have occurred and the management updates as well, even the financial ones too, and all the others as well, just to get some more context and color about the business and get an idea for like what strategy sort of things they're working on, what changes in management are happening, and any other sort of projects they're working on. And this helps me paint like a story of like what's happened in the past, and also what they're starting to work on here that might have some payoffs down the future, right? So if a new really high performing executive joins, or if a new project they're working on back in like mid 2019 that they say will take a few years to pay off, if that kind of thing happens, and that's what I can see here, and I can see how the market reacts to it as well. Like if the market, if the stock price, for example, increases significantly after a bit of news, then I can be like, oh, well, the market was optimistic on that piece of news, and that's the sort of insights I can gain from it. So that's what I use this section for. And also, it's just interesting to see that like even though it's reduced or declined like 50% since like its highs in July this year, down to like 235 from like 470 on. It's increased like fivefold since 2018. So it's been an incredible stock if you've held it for that period of time. Even since like mid 2019, to be honest, it's been a good stock to hold. But with any high growth stock, it's healthy for them to have like pullbacks and some sort of retractment and all that huge share price appreciation. So and that's what the article talked about as well. It's pretty normal to see that. And so this might be an opportunity, considering that the valuation, it said, might be trading at a discount to its expected future cash flows. So this could be like an opportunity where it was richly valued back here, and like it might be an opportunity here. So that's something I'll look into as well. The next bar I typically look at is just like this recent news and updates for the exact same reason, right? Like I want to find out more about the underlying business, and I also want to look at the developments that have been occurring. So here we've got like a senior VP exercising some options and selling stock. Articles from people who are authors that partners that Simply Wall Street has, the likes of Seeking Alpha, and I can get some of their opinions. And I keep in mind, these are just people's opinions, so it's like there's no like completely right or wrong thing. It's just like these are people's own opinion that they've conducted they've generated from their own research. And so this one here says stock continues to deflate from a percent valuation. Earnings, sales, and EBITDA estimates are declining for next year. Shares have further declined over the near term. Now that's that person's opinion on that piece. And why I want to look at these sort of things is like I may have an opinion on a stock, right? Like I may be incredibly bullish from a few little points that I've heard, like the market that it's in is growing incredibly quickly. It's like a huge industry that it's going to be operating in. It's the market leader. A few points here and there that pique my interest at the start. So if I go into it with an optimistic point of view, I don't want to then just read all the optimistic stuff out there for it, right? I want to try and look for some counterpoints and try and see what the other side sees, right? Like see what other people think who are against my optimistic opinion, or vice versa. If I'm bearish, I want to see why people are bullish, just to kind of give myself an informed opinion, so that when I'm looking at a stock, I can actually know that I'm making an informed decision because I've looked at all the pros, I've looked at all the cons, I've looked at all the reasons to be bullish and all the reasons to be bearish, and I've then decided whether or not I truly like, or which ones I truly agree with, like which ones I think are more likely. Like I may look at the bearish ones and go, yeah, no, I see what you mean, but I don't think that's that likely to happen because of X, Y, and Z. I believe these bullish things are more likely to happen. So that's just a point to keep in mind. If you do look at other people's articles of like, or just news outlets and things out there of opinions, then it's worth keeping in mind that it's useful to look at contrary opinions because it can really help you then make a more informed decision because they may bring up some things that you're not fully aware of and it'll help you make a more informed decision. So that's what I use this section for. It gives me a great update of like, this is more recent stuff. That one above, I go back like 3 years. This one's more like over the last month or so. And just provides more context in the business. So that's the article I was reading that I just showed you before, and I'll have a link to that in the description below. The next part I look at is basically just the shareholder returns, just to see how it's performed compared to its like industry and market. So it actually hasn't had the best year thanks to the recent 50% decline. It's actually down 14% for the year, which is like considering the rest of the sector and market is actually up is obviously disconcerting. Oh, sorry, concerning, but compared to like its 5-year performance, it's pretty normal. The US entertainment industry is up about 10% for the year, and the US market's up about 21%. So these two, this sector and industry and market have done well, but Roku's had like an incredible 3 and 5-year performance, and it's worth keeping in mind that it's pulled back from a really high share price. So I'm looking at that with a grain of salt, given that I know what the longer share price performance is. And so the next part I look at is if I'm not too familiar with the business, I'll just have a read about the company. I've had a little bit of reading of the business, so I won't do this video, but I would read more about what it does here, just to specifically get an idea of like how many accounts it has, like what the business actually does, how many accounts it has, what it offers in terms of its products and services, just to get an idea of what space it operates in, and like seeing when it was founded, like 2002, and what it does. So that gives me some great context there. The next section I look at is the fundamental summary, basically just 3 really key metrics. So market cap, revenue, and earnings, right? So it tells me here that the market cap is about 31 billion, revenue is about 2.5 billion, and earnings are about 286 million for the trailing 12 months, right? And so those 3 metrics there give it a P/E ratio of about 110. Now, to me, 110 seems very, very high, but something to keep in mind is that a P/E ratio doesn't really make sense unless you have an idea, or it's hard to have context around a P/E ratio, whether it's fair or not, without knowing what the expected future earnings are of a company, right? Future earnings growth. So that this P/E ratio of 110 is high because the company is where it is because the company is expected to have earnings growth of like 33% per year for the next couple of years, right? So I need to then go make the decision of like, okay, do I think 110 is a fair price to pay? 110 times earnings is a fair price to pay considering it's expected to have earnings growth of like 33%. Now, off the top of my head, maybe not, but what's important to keep in mind is that 33% is analyst estimates, right? So when I look into the business further and do those readings that I was telling you about the qualitative aspects of it and the underlying business, I'm going to want to look at like where I think it can grow, like how much market share I think it can have in 5 years' time, then how much like its earnings would be, and like then I want to kind of get my own estimate for what earnings might be, right? Because I may think that, and I'll touch on this shortly, I may think earnings could grow like 50% per year. Or if I'm a bit more pessimistic, I may look at all the projects they're working on, its potential industry market share, and be like, oh, no, it's probably only like 20% earnings growth, therefore I don't think it deserves this high P. So this is all well and good. Looking at looking at the P/E ratio is all well and good, but without looking at like future earnings growth expectations, then having your own, it really doesn't provide much context. So it's really crucial to look at the P/E ratio and then look at what future earnings growth expectations are, so that you can have some context about like what price people are willing to pay for what earnings growth. And the price to sales ratio of 12 isn't too meaningful to me here, given that the company has just made a profit, but at the same point, I think I need to compare this against the other companies that are in its industry to see what kind of multiple of price to sales they're trading on as well, because it would be useful to compare this to other unprofitable companies in the industry just to see like if there's any sort of discrepancy there where it's above or below them. So that's something I might look into as well. And this next section I look at is the earnings and revenue breakdown. So this just gives me like a bit more detail than what we had here from the earnings and revenue. It gives me like the actual cost of revenue and the operating expenses, the expenses as well. So here I can see that to generate the $2.5 billion in revenue, the company had cost of revenue of like 1.2 billion. So that's the cost of generating those sales, right? Like that might be producing the hardware for the particular piece devices that they sell, and other costs that are involved with actually generating revenue. And so that leaves them with a gross profit margin of like 52%, which is pretty good because that gives you plenty of room to then like spend money on your internal operations. So with a gross profit of 1.3 billion, the company spends about 1 billion on expenses, and this is stuff like research and development, sales and marketing, to try and to spread the word, and general and admin, like just general day-to-day operations. And so that totals $1 billion, which at the end of the day leaves them with $286 million for this trailing 12 months for the period to September 30. So this is interesting because like what I'll look at into further, like after this video in more detail, if I'm going to dig deeper into the stock, is I'll have a look at if there's any room for them to kind of like reduce their cost of revenue, like see if there's any room for them to improve their gross margins by maybe like streamlining their expenses in this regard. And then if on the same note, if there's any room for them to streamline their expenses in these sort of areas, or if it's a business that's in the kind of stage where it needs to spend heavily on research and development or sales and marketing to try and gain market share, right? Because if it's in a growth stage, which I think it is, it would make sense for it to heavily invest in these kind of areas and capital expenditures too, which we can touch on later, to try and get that market dominance, right? To try and be the dominant player in its industry. Because you wouldn't want to start reducing your expenses and trying to streamline your process if there's still so much opportunity out there and room for you to reinvest. So it makes sense that you would reinvest in your business in terms of like increase your ad budget or improve your research and development and stuff like that. So this is something I'll look into further, but just gives you an idea of what I kind of think of when I look at this particular section here. So given it's kind of a growth company, I would expect, they're not going to try and cut their expenses anytime soon. Now, the next part I look at is the valuation section. And now, as we saw at the top, this company passes 2 of the 6 metrics. And so I'll dig into them now. So first one was that simply Wall Street, according to its estimate of fair value, which is based on a model, it thinks it could be trading at a discount of about 27% to its estimate of fair value, which is quite interesting, right? So currently trading about 235, and they believe the fair value being 322 per share. Now, that's interesting. I'll go and look at the data, and because this is, I believe, using a discounted cash flow model. Yeah, 2-stage free cash flow to equity model. And basically, this is based off the 24 average of the 24 analysts who have provided estimates for free cash flow. So just to give you some context, these inputs here, the discount rate, as in like all the future cash flows discounted back to today's value, and the perpetual growth rate, as in what the company is expected to grow its earnings into perpetuity after the 10 years, have a big impact on what the company's valuation could be, right? So if I believe for whatever reason that the company needs a higher discount rate, like say 7, 8, 9, 10%, then all of a sudden today's valuation might be way too high, right? Because if I'm discounting the future cash flows at a higher number, then they're actually worth less in today's values, right? Like $110 in the future would be worth like $100 now, whereas if I used a discount rate of like 5% or something, it would be much more than that. So that's something to keep in mind. If you have your own research and reasoning to have like a higher discount rate on the future cash flows, then that could make the current valuation very, very different. And same thing with the other side, right? If you think it deserves a lower discount rate, like 2-3%, for whatever reason, which typically isn't the best idea, but it's like if you were to go that low with the discount rate because of your interest rates and the way they are, then yeah, you might think that today's values are actually pretty fair or like undervalued. So that's something to keep in mind when you look at these models. And same thing with the perpetual growth rate. If you think the companies could grow at like 3 or 4% into perpetuity, like forever, then that would have a big impact on the terminal value of the business in these discounted cash flows. So just something to keep in mind. These are the inputs that that Simply Wall Street has used to generate its model, and you may think differently, and you can go and do your own Excel spreadsheet and then adjust the data and the numbers and see what you can come up with that you believe is reasonable, right? And so just more data on how they got the model got the particular data points and what they are. And then here is just the forecast that are provided first by the analysts out to like 2025. And then from then on, it's the discounted cash flow estimates from Simply Wall Street's model based on like a continuation or extrapolation of the trend that was occurring. And so it's basically showing us the growth rates as they continue into the year like 2031, being a 10-year forecast. And so again, if I believe that they've got huge growth potential and that there's like underappreciated growth prospects and that like in 2026 they could be growing these free cash flows at like 30%, 40% per year, then that would have a big impact on the current value estimate of fair value, right? So that's one thing to keep in mind. Here, this just shows you how the numbers were used and calculated to get that estimate of fair value. And if you really want to get into it and do your own valuation, you can go and create your own spreadsheet and then basically input the numbers that you think are fair based on your research of the business and what you think is likely to occur. So that's just something to keep in mind. That's what I typically do as well, right? So I don't use this estimate of fair value as like a source of truth. It's just an indication of like, here's what the fair value could be based on these estimates. Something to keep in mind. And then if you feel so inclined, you can go and do your own. But I never use this as like a buy or sell recommendation. Like it's more of just an indication of what the fair value could be. So I want to stress that as well. And so yeah, that's the two checks that it passes in this valuation section by the looks of it. Trading below fair value and significantly below fair value, being more than a 20% discount. So in those respects, it looks pretty good. And I'll go do my own after the video, just if I decide I want to keep researching the stock. So the next section is the price to earnings ratio. And this here just compares it to the industry and market that it's in. And basically, according to the comparison between the industry and market, it doesn't seem to be good value at all, right? So entertainment industry has an average of like 31 times earnings, and the market's trading like average of 17 times earnings. So in both respects, it's trading at a much higher multiple. But like I mentioned, it's important to keep in mind what the future expectations are, and I'll get to that in just a second in the future growth. To compare how the industry and the market are also expected to grow their earnings, because that'll give me some context on whether this is like a fair to be like trading much higher, or if it makes sense, or if it doesn't make sense and it should be much lower. So it's just something to keep in mind. The price to earnings growth ratio isn't too meaningful to me in this situation, so I won't go into it, but it basically just compares the growth rate compared to like or forecasted growth rate compared to the current price, but it's not too meaningful to me here. Same thing with price to book ratio for this kind of business, not too meaningful to me here. And so yeah, that leads us to the future growth section, right? So in this video, this particular business seems to be doing really well, where it passes 5 of the 6 metric checks. And as we saw before, it passes, or it expects to have 33% per year annual earnings growth in the next couple of years. And that's the estimate of the 24 analysts that are covering it. So the average of the estimates. So having a look at this chart, I can really basically get an idea of like what the trend is, if there's any sort of underlying trend that's occurring. And the first thing I see is that there's a typical top line trend of the revenue just growing very, very quickly. So it's currently, where is it, 2.5 billion for the trailing 12 months, and it was about 655 million back in late 2018. So it's had incredible growth for the last couple of years, like 40% revenue growth, I think, per year. And so it looks like that's expected to continue, and it could reach like $5 billion by the end of 2023. So continuation of top line revenue is expected from virtually all the analysts that cover it. And then what I look for in the trend as well is like how underlying earnings and free cash flow and cash flow from operations are trending. And considering earnings and looks like free cash flow for a period as well were in the negative over 2020, they actually have trended up and done pretty well over the past 12 months. And they're now all in the black. So it looks like the trend and the estimate from analysts is that they're likely expected to continue growing, even though earnings from 286 million look to actually go down a bit in 2023, but then recover to about 472 million by the end of 2023. So a bit of a dip in earnings over the next year or so, and I'm going to actually have a look into why that is, right? Because the forecasted earnings growth of 33% per year seems like it's not going to be just a straight line. It seems like it might actually go back down to 222 million by the end of next year for the trailing 12 months, and then recover heaps to 472. So that's interesting because free cash flow and cash from operations seem to be continuing in a straight sort of upward trajectory. So I'll have a look at why earnings might be predicted to go down, and ultimately, like, it doesn't seem to be a huge issue considering they're expected to go up. They're not expected to stay down there for too long. So that's what I'm just seeing here. Now the next part I look at is the analyst future growth forecast, and basically this is just a comparison of the company versus the industry and market that it's in, right? So this helps me get context about the PE ratios that I saw above. And as we saw, the company is trading at a PE ratio of like 110, and it also subsequently has the highest earnings growth of these comparables, right? So 110 times earnings, you get 33% earnings growth, whereas the industry was trading at like 31 times earnings and has 27 times earnings growth. So straight away that actually kind of tells me, well, that seems like a better ratio, right? Like if there is stocks out there that are trading like 31 times earnings and have 27% earnings growth, then that is a very appealing combination, right? Whereas this company with 110 times earnings only expected to have a couple of percentage points, but I mean, a couple of percentage points over long term does make a big difference. But considering it's like 110 versus 31, that's a big disparity. So what I'm seeing here is that actually maybe there is better opportunities out there in the US entertainment industry to actually have a look at like a better price to growth sort of ratio for a stock out there. So what I'll go and do is I'll go and use the screener and I'll go and look at the US entertainment industry and screen for anything that has earnings growth over 25% pretty much and see what I can find, or maybe over 20% and see what I can find if there's any better opportunities out there. So, and just a confirmation, like the market's trading at 17 times earnings, but it's only expected to have earnings growth of like 14%. So that explains why it's expected to have lower, it's trading at a cheaper multiple because it's expected to have lower earnings growth than these two comparables as well. As for the annual revenue growth, it looks like the same sort of story, right? So the company, Roku, is expected to have huge top line growth, 24% per year, compared to the industry being 15% and the market being 10%. That also supports why it was trading at a higher multiple there. So that kind of makes sense to me in terms of the revenue growth. But like I said, for the earnings growth, I might have a look at what the peers are and if there's any better opportunities out there. So for all these 5 metrics here, it passes these checks very well. So that's good to see. Now, the next part I check is the earnings per share growth forecast. And this is similar to the future section. Well, it is still the future section, but similar to the forecast where basically I want to go and form my own opinion to then get an idea on these, right? So if you're not familiar with this area, basically this thick blue line here is the earnings per share previously and what they have been for the trailing 12 months. And as you can see, they were in losses in 2020. And the blue area here and red, the shaded area, is the analyst forecast for what they believed earnings per share could be, right? So it's from the most optimistic being the top and the most pessimistic or least optimistic at the bottom, right? So that's the range of estimates. And then going forward, same thing. The teal line is the average of the estimates, and the teal shaded area is the range of analyst estimates, right? So what they think earnings per share could be, and so like the most optimistic analyst versus the least optimistic or most pessimistic. So what I can see here is that it confirms that the earnings are expected to decline over the next year, but then basically by 2023 they're expected to recover back up to like an average, or the average of the estimates is like 332, 330 compared to $2.18 right now. So plenty of growth over the course of the next 2 years in that regard. Now, what I mentioned was I want to go and look at the underlying business and try and find out what is going on, and then have a look at where I think the business could be at that time by the end of 2023 and where I think earnings per share could be at that time, right? Because if I look at the business, like I said earlier, and I think, oh, it's got great growth prospects, it's got really good potential to have underlying earnings growth, these initiatives they're working on right now are going to be really profitable, I think the market's underappreciating that. Therefore, I believe it has earnings per share potential of like $4.92 by the end of 2023. Then I may look at today's valuation, and as a matter of fact, I may, or because of that, I may think rather than 33%, which is what the earnings above are based on, I may think it could have earnings growth of like 40 or 50% per year, right? Whatever this number ends up being as a compound annual growth rate. And I think, oh, well, today's price is actually really fair, right? Like it's actually underappreciating. I think people are underappreciating how much growth it could have. So that's one thing to keep in mind. And then it could be on the alternative side of that, right? Like you look at the same facts and I think, oh, nah, I don't think it's going to have as much growth as everyone thinks it's going to have. Like these projects aren't going to deliver much bottom line earnings growth. It's just not going to perform as well as everyone thinks it does. I may then agree with this, like this earnings per share estimate down here, or even less, right? And I may think, yeah, $1.41 is likely to happen. Therefore, today's price is hugely overvalued and not fair. So that's something to keep in mind, right? These are analysts who have looked at the business and they have their own estimates based on what they think is going to happen. I can then be my own analyst, which is what we as investors want to be and what we at Simply Wall Street want to help do. You can then go and make your own forecast on what you think is going to happen and occur, and then you can make your own judgment about what you think future growth prospects are likely to be, and then whether you think today's price is fair or not based on those estimates. But you can then obviously, of course, look at the same prospects and be like, yeah, I totally agree with the analysts here. These totally make sense. So this is just a guide to show you what the breakdown of the range of estimates are. So it's very useful in that respect still too. And the last part of the future growth section is just the future return on equity. And I look at this just to see how profitable the company is expected to allocate shareholders' equity in the future, right? So is it expected to generate a high return on its equity on shareholders' money in 3 years' time? And according to the analysts who provide estimates, not really. Like, it's expected to generate a return of like 12% on equity in 3 years' time, and compared to the industry of about 10.6%, that's obviously a bit better, but it's not like a standout performer, so it's not exactly hugely profitable. Anything over 20% is actually considered good, and in this case, 12% is not that great, but at least it's a tiny bit better than the industry. So tells me it's not the most profitable industry, and that might just be because it's reinvesting in itself heaps. But that's again something I can look into further. Like, are they reinvesting heaps in research and development or sales and marketing and stuff like that? Or is it just like a business where its gross margins are going to stay like that because it can't afford to reduce costs or can't find ways to reduce costs, and it just has to, that's the kind of return it gets. So that's something I can look into further as well. Next section I look at is the past performance. So basically just seeing if it has a reliable track record of performance and if it has like a proven business model, right? So here it seems it does, but 47% earnings growth over the past 5 years. Now, I think it's from negative, so considering it crosses zero, the growth percentage could be a bit off. Considering it crosses zero, it's very difficult to calculate, but that's just something to keep in mind. And I can see here that the top line growth has just been huge, right? Like I said, it's just grown incredibly quickly from, well, this is 2015 now, so even further back, 319 million up into like 2.5 billion now. So huge growth in terms of its top line. And what I look for here is basically just to see how the trends are occurring. And to be fair, it looks like it's been pretty steady over the past couple of years in terms of earnings and free cash flow being negative, like it seems to be reinvesting in itself heaps. But as of late, it's actually been able to generate a profit, and that seems to just be because of huge top line growth, right? Like it's just been exponential in the last year or two. Now, what I also look at here in this section, which is important, is the operating expenses, right? Like what expenses does the company have that it has to spend on its operations, right? And so you can see here it's 1.05 billion, and that's virtually the same as what we saw for the expenses up above, right? And this is the stuff that just like, what does the company need to spend to run its business? And the key thing I look for here is I want to see that revenue is growing faster than the company's operating expenses, right? Because then it's generating scale where it doesn't need to spend an incremental dollar to generate an incremental dollar of sales, right? If every incremental dollar it spends, it generates like $1.50 worth of sales, right? So I can see here that the revenue has well outpaced the growth of operating expenses over these past couple of years, and that's great because obviously that contributes to this bottom line growth, right? So that's what you want to look for in this past section, and it seems like this company has done that. But something to keep an eye out for is if the operating expenses were to grow in line with revenue, that's a bit concerning, right? Because it's like they have to then spend that incremental dollar to generate an incremental dollar of revenue. So in this case, doesn't need to be the case. It's like it's reaching scale, and that's good to see. So the next part I look at is the past earnings growth analysis, basically very similar to the future growth section that we just looked at before, when it compares it to the industry and market. So past 5 years earnings growth seems to have done very well, growing its bottom line, much better than the industry, growing at 25% per year, and much better than the market, growing at 13 times per year. So again, that might be why it's trading at a higher multiple, because it has higher expectations because it's had so much growth in the past. And as for the last 1 year earnings growth, it's hard to do the percentage calculation because it's become profitable, right? So it's gone from below zero to above zero. So it's not applicable here, but it's good, and it's still like it's good. It's promising to see it's become profitable. But the industry and market has had very good earnings growth actually. So 18% in the last year for the industry and 41% for the market. So huge year for the US market, and that's just what it tells me about its past performance. So the next part I look at in the past performance is just in regards to like the profitability metrics. So return on equity, return on assets, and return on capital employed. Return on equity just tells me how profitably it's currently allocating shareholders' equity. And I can see here that it's like roughly in line with the industry actually. So 10.7% versus 10.6%. So it makes sense that it's pretty much in line. Nothing really stand out, so it's not exactly the most profitable, but I'm not too concerned with that, considering the business needs to reinvest in itself, and so it's not actually expected to be that profitable right now. But I want to know, the point is I'm looking at this versus the future return on equity. So the future return on equity is only expected to improve to like by 2 percentage points, right, in the future. And so with that in mind, it's like, as a shareholder, I want to know that they're profitably reinvesting our capital, which is their earnings and our earnings. And so 12% isn't that great, right? So there may be more profitable opportunities out there with other stocks, but that's just something to keep in mind. And the next part I look at is just the return on assets and the return on capital employed. So return on capital employed, I just want to compare it to how it did 3 years ago. And so I can see it was actually negative 3 years ago because it was loss making. But last year was about 8.7%. So it's good to see that it's moving in the right direction. And if this trend continues, it could hopefully continue to improve. But this also depends on like how it utilizes debt and equity, right? So this is total assets minus current liabilities. So this can be skewed if they decide to take on more liabilities to reduce that number. But that's something I'll keep in mind, right? Like if they take on heaps of current liabilities for whatever reason, take on heaps of small liabilities, short-term liabilities, that can change this figure. So maybe they could utilize debt a bit better if they took on some sort of leverage, because according to Financial Health, they have a pristine balance sheet. Maybe they have some room left in their balance sheet to actually take on a bit more leverage to improve these sort of return metrics where they're not so reliant on their equity. But that's just something to keep in mind for how they can utilize their financing structures better. And then return on assets, it's obviously not the most asset intensive business, but it's also not the most profitable. So its return on assets is roughly in line with the industry at like 7.4%. So that's not too meaningful to me, but it's still just interesting to know. Now the next section is financial health, and I just look at this to basically just see if like there's any risk of bankruptcy, right? Or if the company's like incredibly leveraged. And in this case, it doesn't seem to be the case at all, right? So it doesn't seem to be very leveraged and doesn't seem to have any risk of bankruptcy at the current stage, right? So its short-term assets, being cash and cash equivalents, significantly outweigh its short-term liabilities, which is basically any sort of obligations due in the next 12 months, like accounts payable and stuff like that. And then also I just want to see that the short-term assets, like cash and cash equivalents, can surpass long-term liabilities, which is anything, any obligation due over 12 months, greater than 12 months. And so it can easily pass both these things with the cash that it has on hand. So that's great to see. It's really got an awesome cash buffer. The next thing I look at is just the debt to equity history and analysis. And I just want to see how the company's been utilizing debt and equity in its capital structure, right? Because there's two ways you can fund your operations, through debt or equity. And they have pros and cons of each, right? Like debt being bankruptcy risk, but also you don't dilute shareholders is the pro, bankruptcy risk being the con. And equity is like, well, you don't have an obligation to pay them back, right? But the con is that it's like, well, it's dilutive, right? If you keep issuing equity, you'll keep diluting existing shareholders. But it's good to see that also the cash balance here has been trending up and to the right? So it has actually done incredibly well, but it may very well have done an equity raise here. I'll have to look into that. If you know Roku, you probably already know. But it may have done a few equity raises over these past couple of years because its cash and equity value have just increased significantly over the past 2 years. And so I just want to have a look into that. If it does seem to be using equity, which kind of supports the thing that I saw above, which was the risk that shareholders have been diluted over the past year. And that could be what we're looking at here, right? Like shareholders have been diluted because the company's issued more equity. So it doesn't seem to be the most leveraged company at all. Like it's only got 93 million worth in debt, but it's got 2.1 billion in cash. So plenty to spend, but not much due to be paid. So plenty of flexibility in that sense, which is good to see. So it passes all these checks here, which is great, very promising. Just a balance sheet breakdown here, just gives me more idea of like the assets and liabilities and equities that it has. And I'll look into that if there was any concern, but to be honest, at the moment there isn't really. The next section I'll look at is the dividend, but in this case I won't look at it because obviously it doesn't pay a dividend, so I'm not really going to do any analysis in that section. And just something to keep in mind is like obviously if a company chooses not to pay a dividend, doesn't mean it's a bad stock, right? Like a business could choose to not pay a dividend, just like Roku here or Amazon or whatever. They're currently not paying a dividend because it chooses to reinvest in itself. And one thing to keep in mind is you would be, as a shareholder, it would be wise to encourage a business to reinvest in itself if it has great reinvestment prospects, right? Like if it's got a massive opportunity in front of it where it can reinvest in itself to like gain market leadership in a hugely growing industry that's going to be around for 5, 10, 15, 20, 30 years, you would want the business to reinvest in itself. If it's like a first to market, like first mover advantage sort of thing, or it's a winner takes all market, and this business has profitable reinvestment opportunities, which you can tell by the return on equity and return on capital employed metrics, then yeah, you would be like, okay, well, if you're generating heaps of return on your investments, then yeah, please continue to reinvest in yourself because you'll get the company would get bigger and more dominant, and then it gets to a stage in a couple of years' time when it's like, okay, we don't have any good reinvestment opportunities, we're generating heaps of cash, we can now return some to shareholders. So that's something to keep in mind. Like a business may be in that stage where it needs to reinvest in itself and it's not ready to pay a dividend. So just because it doesn't pay one doesn't mean it's not a good stock. So I'll just skip over this section here, considering it doesn't pay one. Now the next section I look at is the management. I just want to know like who the people running the company are and basically if they're aligned with shareholders or not. And so just looking at the average tenure, 3.2 years, that tells me that's pretty good, right? There isn't a high turnover of management staff. Like they're actually typically on average, they stay there for a couple of years. That's great to see. And then I just want to learn a bit about the CEO as well, right? Like the person who's operating at the top of the business. And so Anthony Wood, I believe he's the founder of Roku, founded in 2002. And then I just read a bit about him here just to get an idea of his history and what he's done before. And I can just see his compensation here, but there's a bit of analysis on this in a second. So yeah, here's the analysis. I just want to see that he's kind of being aligned. He's being compensated in alignment with shareholders, and ultimately, his compensation is kind of tied to company performance, right? And so it seems like his equity compensation, like his salary has been flat for the last couple of years and maybe before that too. But I can see here that his equity has grown, his total compensation has grown incredibly quickly. And that might be through stock options and sort of any other non-salary compensation methods that you're getting paid. But it seems like over the last year, in terms of like over 2020, while it was higher than businesses that are similar size, it actually moved in line with company performance because company performance has increased so much over the past year. So not too concerning, to be honest, because like not only is he a founder, but his compensation is in alignment with company performance. Now, I'll just want to see the next section, which shows me how many shares he has. So in this section here, I just look at all the members of the management team and just have a look at like their profiles and like see what they are. But obviously, we just looked at that one for Anthony before. But I want to look at like who they are, what their tenure is, like how long they've been there, what their compensation is in terms of like how much they're paid, and ownership in terms of like how much stock they own. And now there isn't data for a few people here, but for those that do have stock, it looks like they have a fair bit invested, right? So other than this CFO here, who it seems to have zero at the moment, maybe because, I'm not sure, but maybe they have like a personal holding in like a different entity. That's something maybe I'll need to look into. But the people who we do have data for seem to have a lot of money invested, right? So it's still a founder-run business, which is a big tick for me, right? Like they've been there since day dot, and they have a big amount of skin in the game. Like they've got $3.9 billion worth of skin in the game. And then other senior management team here, 18.9 million, 9.7 million. That's a great sign, right? So while there isn't data for these other members here, because doesn't seem to even be data about their tenure, the ones that we do have data for, it seems like they're aligned. So I'll just want to see if I can find any data on these people, and I'll have a look. What I would read through is these client profiles to see where they've been before and if it's like they're only new in the position or something. So that's what I do in this situation. And like I said, 3.2 years is the average tenure, which is good, not high turnover. And so they're pretty experienced in that regard. Now, the same thing for the board members, right? That's what I also look for. Same thing, read through the profiles, look at their tenure, all seems to be pretty good. Only a few people who have been there for less than a year, and then how much they're compensated and how much skin they have in the game. So only a couple of 100,000 here and there for these people here. So it's not the most, considering it's a like $31 billion company. It would probably be good to see at least $1 million or more invested from these people to show that they really have skin in the game, being board members. But yeah, from this takeaway, I would like to see more insider ownership from these board members. I'd like to see more money, considering the size of the business is pretty huge. But still, it's a decent amount of stock. Like, but there's 63,000, not too much. But I'd like to see more. So 5.8 years, so they all stay there for a pretty long time. There's not a huge turnover of board members, which is good to see, right? So they're all considered experienced as well. Now, the very last part I look at is just in regards to ownership, right? So has there been any insiders buying or selling shares? And who are the major shareholders? So looks like there's been some selling over the past 12 months, 6.6 million from one individual back here, and $316,000 worth from here as well. So not too much really to take away. What I would look for here is just if there's any trend of like multiple insiders selling large amounts of stock, or on the other side, multiple insiders buying large amounts of stock. So if there's any big trend of like multiple people acting in a certain way, then that's a sort of a telltale sign for me of like something's going on, or I should look into something. But in this case, there's no real discernible trend that I think I should be concerned about. So I'm not going to look into that too much either. Now, as for the ownership breakdown, this just shows me who has the most say in this particular business, and the institutions seem to have like 60% ownership. General public has like just under a third, and individual insiders, being like the founder, Anthony, has like 12% or thereabouts. So pretty interesting breakdown, but it seems like institutions have the most say in when it comes to like AGM votes on particular issues. So if there's anything that comes to a vote, I would expect that they would have the most say, to be honest. And this was the risk I was talking about before. So shareholders have been diluted in the past year, with total shares outstanding growing by 6%. So this sort of is confirmation that I think there actually was like a share, it's all the way back in the financial health, but there was some shares issued by the looks of it back in over the last 2 years. So I'll look into that and I'll see if it's basically like an issue that I should be concerned about, where I think they might do it again in the future to raise more equity. Because if as a potential shareholder, I'd be like, okay, am I about to be diluted again? And if I think there isn't a likely chance of that happening, like isn't the company self-sufficient or it chooses to take on debt instead because interest rates are so low, that's something that I'll look into. So a shame over the past year that they've done it, but considering the business has been growing so quickly, it seems like it's been outpacing significantly the rate of dilution, so it's not as harmful as it would be if the business wasn't growing as quickly. So not a huge issue, but I'll just try and do some research to see if there's any risk of it happening in the future. And now this next section is the top shareholders bit, and basically I just look for here if there's been any big change in their particular holdings, right? So this is just a more detailed breakdown of what we saw above, and this shows us all the institutions that own stock and the individual insiders. But what I look for here is if there's been any big changes in their position over the past 2 reporting periods, and also how much it makes up of their portfolio. So there's actually been quite a bit of movement here, right? So one institution has been offloading about 16% of their holding, 8%, 4%, like some have been adding 10%, adding 7%, adding 3%, adding 11%. So taking off 24%, adding 25%. So really hard to tell if there's a discernible trend, right? Because it seems like that article was saying institutions do seem to be divided about its prospects, and that seems to add up, right? Because some are increasing their position quite largely or in quite a big way, and then others are actually offloading their position in quite a big way. So prospects for the company seems quite divided from institutions, and there's no real discernible trend to take away from here. So, like there's no real takeaway, but it's worth looking into what each of them might think as to why they might be bearish and why others might be bullish. So the why they might be bearish was explained in that article, like a rich valuation, potential lack of market growth, and the stagnating sort of viewership numbers. That might be why some institutions are offloading their stocks. So just something to keep in mind also, that these institutions have client money and the clients may think those things as well. So that's, like there's no huge trend for me to take away there. So nothing really too meaningful. So that's my review of the company report. Like that's me looking through it after I've read that article, trying to get insights from it. And basically like the company seems to have great future prospects, like earnings will decline over the next year, but it seems to pick up after that. The past track record is okay. The health was impeccable. Like it's got plenty of ability to take on some debt if it wants to. It seems to have been issuing shares instead. And it could be good value. Considering the estimates based on that model that I saw from Simply Wall Street, it could be good value. So I'll go and do more qualitative research on the business and try and get an understanding of its market, like its potential market share, what it can do to improve its earnings, and whether I think the future prospects, or what I think of potential future prospects, like in terms of growth rates, if I believe with 33% or higher or lower. And then also I'll just have a look at that equity issue, like if I think they're going to keep issuing stock to finance their operations. So yeah, that's pretty much my summary of the Roku company report. I hope that's been helpful, and thank you so much for watching.